I'm joined by Christian, a real estate investor, entrepreneur, and chief investment officer of the Aliferous Group. After a successful career in tech, Christian transitioned into a real estate full-time, building a growing portfolio of multi-unit residential and commercial properties. He is also the VP of OREIO and a real estate coach. Christian, how's it going?
Fantastic. How are you?
I'm doing great, and obviously there's a lot more there, but we only have a certain amount of time, so I gotta put in what I can. So, I just want to put some value in there that there's a lot more to what you're doing in terms of experience and everything else than what is just in that intro.
Yeah, no, absolutely. So,
The one of the things that obviously I've gone to a couple of Rios, so I know who you are. You're a pretty well-known name in the real estate space, but um, I saw you speaking for the first time at the multifamily conference in Toronto.
mhm.
What are the one things that there's a couple things that really stuck out from your speaking points, and one of them was the big trend was everyone was leaving Ontario. Obviously, the factors of the landlord-tenant board, the RTA, and all those sort of things kind of played a factor, but they were all moving to more landlord-friendly areas, say like the Bible Belt or Alberta, or you know. But you were saying while everyone's leaving, you're doubling down because you saw the opportunity from that. Can you maybe
Yeah,
just go on a little bit about that?
yeah, absolutely. And I remember that question. So Seth Ferguson posed that question while I was on stage, and he was curious too, because a lot of what he's doing is investing in the US and other popular guys, like my friend Erwin Zito is very much pushing US investments. And there's lots of good reasons for that, right?
Hmm.
Developer-friendly environments are useful in terms of creating sufficient housing supply. Relatively relaxed rules around landlord and tenant interactions, while being fair to all parties if they're relatively non-restrictive, such as rent control, etc. It tends to make for an environment where it's easy to create new rental housing stock. So what you see in environments like Alberta is a good example within Canada. There's a number of US states, and I want to clarify, not all US states are actually landlord friendly
Yep.
at all, right? Like
Yep.
California, New York, they are not landlord friendly. But there are some US states that are. Texas is a good example of one.
Florida.
Yeah, Florida is another great one. And so what you find is that since it's relatively easy to develop new housing and that when you're in that game that it's easy to deal with tenants who are problematic, that the supply tends to match the demand. So as you increase the overall demand, you get more supply coming in to deal with it, sometimes an oversupply. So what you often see in these areas is that the value of the real estate tends to be fairly balanced. It tends to follow the rate of inflation in terms of equity appreciation. That is to say, after inflation, the value of the asset is stable. It's not going up. It's not really going down. So in those regions, it's very much a cash flow play, and that's fine. Nothing wrong with that, right? A lot of people don't realize that you have to have a higher cap rate in those areas so that you're getting cash flow in lieu of appreciation. So when I look at these types of situations and I see provinces such as Ontario and other provinces, BC is probably second only to Ontario in terms of restrictiveness, and we're
Hmm.
seeing other provinces start to go that way as well. But what we see consistently, study after study by economists, is that when you put those restrictions in place, it causes a shortage in the housing supply, which necessarily drives rents up. And
Hmm.
if we go back to the basics of building valuation, a building is worth a multiple of the net operating income. And that multiple is effectively the cap rate, all right,
Hmm.
as you well know. So if I can increase my revenue, right, because rents are going up and the rents are going up because of restrictions in the supply side of it, then my property becomes worth more and I can take equity out in order to continue to invest. So that's sort of a basic as to why I like regions, provinces, states, etc., that are highly restrictive. I don't think it's fair, right? But it is what it is. And I'm going to try and work within the system that's provided there. Now, there's another thing that happens in that type of scenario as well, is that when people leave, right, such as when Seth asked that question, he turned to the audience and said, how many people are actually thinking of moving to invest in the US versus in here in Ontario?
Hmm.
And it was over 70% of the crowd. I mean, you were there, so you would have seen all the hands go up, right? And so
Hmm.
Seth said, why are you investing in Ontario when everybody else is leaving? And I kind of had this quip that came back, "It's because everybody's leaving." Right? It
Yeah.
was simple. They're all leaving. So where's the supply? It was just an
Yep.
exact case in point. And then I'm reminded as well of you're based in Cornwall, so I'm sure you know who Minto is, right? Minto, a big real estate developer based primarily out of Ottawa, but they've got presence in Eastern Ontario and Southern Ontario as well.
Hmm.
And so the founder of Minto was a guy named Irving Greenberg. And Irving was around in the 70s when rent control got put into place. And there's a whole history behind that, right? It was tax reforms of 1972, which ended up causing the rental shortage. And then after that tax reform in 1972, the vacancy rate went from 6% down to 2%. There was a lot of pressure over that 3 years by the then government to put in rent controls because they saw the vacancy rates plummeting.
Hmm.
And it was the federal government that had actually caused the root issue, and then the province responded with rent control. So when rent control was introduced, Irving looked at it and he said, when rent control was introduced, it was the best day of my professional life, right? And why is that? For very much the reasons I cited before. He knew that a lot of landlords wanted to then exit, and a lot of institutional landlords decided, you know what, this is getting ridiculous. I'm leaving. I'm going to invest in other provinces. So Irving ended up buying a bunch of assets at a discount because people were nervous and petrified. And then he was looking at it on the other side of it and saying, if you do commercial leasing, for example, often people will choose to adjust their rents every once in a while, but they don't do it necessarily on a regular basis unless they write it in their lease that way. And what
Hmm.
was happening before rent controls is people would not do pass on any rent increases for 2 or 3 years, and then every once in a while they wanted to catch up based on inflation. Once you have rent control, the thing that Irving observed is that now the province has mandated what a rent increase can be every year. So now you can turn to that and say, the province requires me or makes me effectively increase it every year because if I don't, then I lose it. Therefore, I do a rent increase every year, which allows me to keep up with the rate of
Hmm.
inflation. So for that and a number of other reasons, Irving was just incredibly happy about rent control, and I tend to mirror, if you will, or mimic the that very that very
Model.
that very thought process and why I think it's good. And it has been wonderful for me, right? At the end of
Hmm.
the day. So do I want a more balanced system? Absolutely. Do I advocate for it? I'm involved in all kinds of rental housing advocacy groups to do exactly that. I believe in removing the restriction on supply and making sure that we have a balanced market, right? But in the absence of governments creating a balanced market and putting on additional restrictions, I can't help but benefit from that. So a long answer to a very simple question, but I think it was worth it.
No, I love it. That's perfect. It's almost like that. Obviously, there's more at play there, but it's almost like that Warren Buffett quote. When others are greedy, be fearful, and then when others are fearful, be greedy.
Yep.
The
And
other thing,
that's the market we're in now too, by the way, right? People are
yeah.
still fearful. So
Speaking about that, if you're like a beginner investor, or say maybe you have like two or three properties, still a beginner in that sense, but um, in these markets where we're say in a soft market right now, or when we're in a more hotter market, is there anything that you're pivoting on, or what you would recommend for them to pivot on, depending on that market, or is it just kind of stay with the fundamentals,
yeah. It the fundamentals are always really important. So I'm a strong advocate for figuring out how to get cash flow in any asset you acquire.
Hmm.
And it's the baseline of what I do. I either, as I say, I either buy an asset that cash flows on acquisition, or I have a plan that takes that asset and converts it to cash flow when I'm finished that project. And this fundamental reason is that's the only way you can scale your operations. If you're buying something at a deficit, you can only buy so much before you just don't have any more money to sustain it. So to me, that's always a fundamental. It's also important to buy right, in the sense that one is that if you know the property is not likely to appreciate, then you have to make your business case based on the cash flow, right? Has
Mhm.
to. So I always have a well-defined business case that says this is how I'm going to make my money when I buy an asset. I generate a certain amount of equity, I generate a certain contribution to cash flow, etc. And I stick to that. If I can't figure out how I'm going to make money, it's not worth buying the asset, right? You just stay away from it.
Mhm.
So all those things are still fundamental. So a friend of mine, Mark Amiot, asked me one day, and he interviewed me when we were at OREIO, and he said, "What's your favorite asset class?" Right? And
Mhm.
I don't know if you can guess what I answered, but
The
so
one that makes
when
me money.
the one that makes me money, that's
Yeah.
exactly you got it. And that's true. I mean, that's literally why I have a fairly diverse portfolio. Is depending on the situation that you're in, you can buy assets at a discount.
Mhm.
So multifamily assets tend to be still at a premium. So I
Mhm.
haven't really bought a ton of multifamily in the last 3, 4 years. Instead, I've been buying, like I bought office space last year.
Nice.
Why? Because nobody wants to buy office space,
Yeah, smart.
right? And even if people do want to buy office space, they don't know how to fund it because
Mhm.
you go to any A lenders and you tell them that you're buying office buildings, and they'll just say, yeah, not us.
Yeah.
So you have to get creative in terms of how you get those things financed, but you're getting them at an incredible discount. Are they going to be challenging to fill in the short term? Sometimes, right? But I buy stuff that's on main streets that are sought after assets that people want to lease up in, and so they tend to be fairly good. Another asset class I've been buying over the last 3 years, 4 years is mixed use. Commercial at the podium level, so right on the street level, and then residential up above.
Mhm.
Those are also very good assets because the people who traditionally hunt multifamily get intimidated by the commercial piece.
Yeah.
But as you know, Garrett, and I'll tell your listeners a secret, the commercial piece really isn't all that hard. So if you're doing commercial multifamily, which is anything, 5+ units at least, if you're already doing that stuff to add pure commercial pieces like retail, etc., is there's some differences, of course. The commercial leases are different and the terms are different, but it's nothing that anybody can't learn, right? So
Mhm.
by going after those kinds of other assets, you'll get better values. You'll get a better discount on the value of the asset. It'll cash flow faster. And then, something like a mixed use, like I described, if the commercial space is 30% or less of the gross leasable area,
Mhm.
and the rest is residential, CMHC will still underwrite that, right? And
Yeah.
they'll still insure it. So you can still go after it, which is great. So it all changes. In 2017, I bought light industrial properties. Why? Because I needed cash flow in my business. At
Mhm.
the time, I'd gone professional in 2017, if you will, right? So
Yeah.
I went from being a hobby investor, which most of us start out at. I had a career before that, and I acquired assets. And at that point, my assets were becoming so overwhelming, I had to choose which path I was on. And so I left my job, my high tech job at the time, and I focused on real estate, got cash flowing assets and light industrial at the time. You could pick up at 10 caps, 12 caps,
Mhm.
and they would work. And, because they were built to suit, you typically weren't. Um, you typically weren't expecting any appreciation out of it. But at the time, I needed to, increase the cash flow of the business in order to be able to sustain not just myself, but also build a team that could then go on and do other things. And a cool thing happened that I didn't expect was during the pandemic,
Mhm.
light industrial space, warehouse space became highly sought after, right?
Yeah.
Because of last mile distribution. And all of the industrial properties that I had that I bought at between 10 and 12 caps suddenly came down to 6 caps.
Wow.
right? So those buildings doubled over
Yeah,
that time, and they've stayed there. So
beautiful.
it turned out to be nice assets. Sometimes you get surprise upsides like that.
For
So
sure. The other thing at the when we're at the multifamily conference that that you brought up that kind of resonated a lot too is that up at that point you weren't ha bringing on investors to fund projects. Everything was kind of internal. Could
yeah,
you maybe go on with the motivation behind that and the reasoning behind that?
yeah. Most people seem surprised by this. For me, it was just natural, I guess, and
Hmm.
um, I always want to make sure I have control of what I have.
Hmm.
And I don't want to have to be beholden to somebody else. So let's say I bought asset A and I did that with partners and I have a bunch of equity in there and we're going to do a project with it. But suddenly asset B or project B shows up and that's even more interesting for me. Well, now I'm kind of beholden to the first project, right? Because I've got
Hmm.
investors and I have to make sure they're all okay. And maybe I can go and still do project B, but at some point it starts to become a problem in terms of how many things you can do at once
Yeah.
and still make a good return. So I've always wanted to stay in complete control of my situation, and I've been able to do that successfully simply by driving up the value of the properties that I have. So this goes back to what I was saying earlier. When I buy a property, I have a business case. That business case has a cash flow output requirement when it's done. And there's also an improvement in value. So I usually buy buildings that aren't at their highest and best use yet in one shape or another. So, for example, I bought an industrial building. It used to be a manufacturing building and cut it up into different modules in there in order to create separate light industrial bays, and that increased the revenue and the net operating income in there by well over 50%. Okay,
Wow.
so that increases the value of the building, and then I can do a refinance, take equity out, and continue to build. So I'm always looking for opportunities to increase the amount of equity takeout that I get in order to self-fund the next set of acquisitions. The one downfall of that is it slows me down, right? So it
Yeah.
can't, I can't maybe build as fast as others. But on the other side of it, 100% of the assets that my firm owns are 100% owned by us. The cash flow is 100% towards our operations. And I don't need to share that with anybody. So
Yep. No.
I might not have, hundreds of thousands of doors, right? Right. But at the same time, I don't have 5% of 100,000 doors, right? Like they're all
Yeah.
mine. They're
That's
all
a,
mine.
I find that's kind of one of the funniest things in space. People claim they own 1,500 doors, but they really only own a very minor position in those and
Yeah,
very kind of ego driven. But
it is. And, I've never believed in, you know, bragging about, how many doors anybody has because exactly as you point out, it can be very misleading in
hmm.
terms of what's actually happening. And at the end of the day, what matters is what personal wealth are you building with the investments that you do, however you choose to do it. And there's nothing wrong with raising capital. In fact,
Hmm.
it's something that I'm considering actually maybe later this year or into next year because I've got certain large, very large projects that intrigue me, right? Just some opportunities that I look at and say, like revitalization of downtown cores.
Okay,
Okay,
well.
well, I simply don't have enough money to be able to do an entire downtown core,
Hmm.
right? I have the expertise, right? But now I may need to bring in some good money in there with like-minded investors in order to be able to do that revitalization. And that's something that can only be done through capital raise, right? But it's not where I gravitate. And as we were talking before the show, I was like, it's not like I do this because I need the money.
Hmm.
I don't, right? We've done well. Our business is relatively large. My children and some of my family work within the business as well as some of the other staff.
Love it.
One of the reasons I continue is one, I have fun with this. It honestly just gets me excited all the time see the kinds of projects that we take on and see the results. But it's also to make sure my younger daughter, who's my right-hand person, sees exactly how this is done. So at some point, she's my succession plan.
Yeah, I love that. It's like almost like the real definition of financial freedom, eh?
Yeah,
It's, it's it's not always retiring, it's doing what you love with the people you love and
yeah, that I think that's quite accurate, but I'll also be honest that I've only ever made good money in real estate. And and that's somebody coming from a high-tech career, right?
Yep.
Going from a salaried individual to an entrepreneur is honestly one of the most freeing things that you can ever do, right?
I think one of the things like, you can get rich off a salary, right? A high tech job, but you build wealth off of, real estate or things like that, entrepreneurship, businesses. Um,
Yeah. Yeah, it's the problem with a salary job is there's a certain amount of security in there, but anybody who's been in the job market long enough knows that, a salary does not equate job security in reality.
mhm,
Things change all the time, and it limits you as well. Like the amount that you can spend and what you can do is fundamentally governed by the salary you're able to negotiate, right? So it's effectively getting you some form of a dividend or annuity that's called a paycheck. But when you are an entrepreneur, you can build a business, and the business is something that has a value that's easily calculated. So just like in real estate, with commercial real estate, as you know, valuation of the building is a multiple of the net operating income. So if you
mhm,
can increase the net operating income, you necessarily increase the value of the building. And it's exactly the same for businesses.
mhm,
So in businesses, you're typically looking at EBITDA, which is roughly equivalent to NOI or net operating income.
mhm.
And it's a multiple of that, right? So every business has a multiple value. And so what you can get for your business depends on how much you can expand that EBITDA value or that net income value. And so it's exactly the same. So whenever I think about, okay, well, I need to create more money, I think about, okay, where can I add new value so
Love it.
that I overall increase the amount of equity that I have to go do the next thing?
I love it. So you take that value add approach to everything in terms of, the business and everything else in your life. I love that.
Yep.
I think it was Andrew Carnegie. Obviously, it's a little bit different now. Obviously, there's, the financial sector and things like that, but I think more millionaires were created from real estate than any other asset class. It's
Yeah, and it's understandable. And
Mhm.
again, it's one of those things. A lot of people buy real estate because they think just by buying it, it's going to make them rich. And or make them wealthy, I think is the word you used, which is probably more appropriate. And the reality is that when you buy an asset and you don't do anything to transform it, you're effectively just storing your money in an inflation hedged asset.
Yep.
And there's nothing wrong with that. It preserves the wealth that you have, and a lot of large family offices do exactly that. They're kind of risk adverse and they just want to protect against the ravages of inflation.
Hmm.
To really make money in real estate means that you have to do something very fundamental to change the value of the asset that you have. And it could be something as simple as I have a house and now I suite it. Okay.
Yep.
Although that tends to be a little bit limiting because of the way that small assets are valued from an appraisal perspective. And that's why I always like going to anything that's in the commercial space. And that could be a 5 unit residential, it could be retail space, whatever it happens to be, because there you have absolute direct control over how you're going to get new equity and
Yep.
make new money. It's not a mystery. It's an absolute mathematical science.
That was the first thing that kind of like when I started learning about, commercial real estate, and that was one of the first things that really stuck out to me. If I could just increase the $200 per door, whether that's getting the rent up or, fixing that leaky toilet to lower the water costs or whatever else, that, over a 32 unit or something else, that could be, $800 or 800,000, 1.1 million, or, it's just crazy to think of it that, you know,
Absolutely. That's
and
right.
and
And
so many people don't even like even have an idea of that exists in this world.
Yeah, that's right, and that's why I think we're both making that point, right? Is that it's really important for people to understand there are certain asset classes where the leverage is easier, right?
Hmm.
And when we're thinking about assets that are fundamentally valued on net operating income, there's two levers, revenue and expense.
Hmm.
So if you can increase your revenue, that's always the easiest path, right? And it might
Yeah.
be, when you talked about $200 a door, well, it doesn't necessarily have to be through pure rent increase. What if you're offering an insurance product, right? Or what
Hmm.
if you're offering internet services or telecom services, or maybe you're going to offer maid services, right? Well, there's margin in that stuff, right?
Hmm.
That you can offer. And suddenly you're getting additional revenue, and that translates all the way down, because your expenses only went up modestly for those services. So therefore, your NOI necessarily increases, and therefore the value of your building increases. Adding parking, adding laundry, adding, all these kinds of things. There's tons of stuff you can do. And then on the other side, right, you were talking about shaving on expenses. Absolutely. So the leaky toilet. So one of the
Hmm.
things that I do is I use a water monitoring product called Flowy from Alert Labs.
Oh, wow.
And we put that on every water meter. There's other solutions. I just happen to standardize on Flowy, but you just literally put that on the water meter and it measures the amount of water flow through, and it has some machine learning capabilities in there. So it recognizes when something as simple as a low, slow leaking toilet is happening. And so then you know to go investigate and fix it. Whereas before, you never know what was happening. And
Hmm.
you'll just start seeing larger and larger water bills and not know what's happening. And if that persists and you never noticed it from the beginning, then the value you're building changes as a result of this mismanagement of water. So,
Hmm.
but there's all kinds of other things that you can do to manage expenses, and they are worth doing. But it's also the law of diminishing returns, which is why I say do what you can around expenses, the easy
Hmm.
wins, but focus on the revenue side in some way.
I love it. So would you say when somebody's starting out, when would they transition to that more those like the commercial real estate, the 5+ units? Would you start them off with like let's start with the single family, the duplex, or would you say, look, maybe get a mentor, a coach, a partner? Obviously, I know you started with a partner with Aliferous, right?
Well, yeah, my wife at the time was absolutely my business partner, and she's still my
Hmm.
business partner. So,
Yeah.
but that's it, right? Like it was, we didn't know what we were doing when we started, and we didn't think that a 5 or 6 unit building was going to be any more difficult than a single family home. It just
Hmm.
never occurred to us that it would be any different. So we just started off that way. We started off in the commercial space.
Yeah.
And we've never looked back, honestly. So the reality is that a lot of people think you need more capital in order to get the bigger buildings, but in a lot of cases, you might even need less capital, depending on where and how you buy it. Because depending on things like interest rates and which product you might use from CMHC for insurance or the mortgage insurance, you may find that you have a little bit less money or about the same amount of money to put down on a commercial asset, like on a residential commercial asset,
Hmm.
versus, say, a single family home. But the ability to manage the outcomes is much better. So, in my view, going straight to the commercial class, now I'm not talking about office buildings and industrial.
Yeah.
Those are a bit more challenging, to be fair. But if you're just talking about like a 5 unit, small 5 unit apartment building versus a duplex, right? I'd go for the five without any
Perfect.
doubt. And there's a bit more work, but it's not a lot more work. And I'll remember when I used to work in the high tech world, I had the privilege of working in mergers and acquisitions.
Awesome.
And I remember my CEO at the time said, well, Christian, he said, it's just as much work to buy a little firm as it is a big firm.
Yeah.
And it's kind of the same with assets. You could buy, if you had the capital, you could buy a 100 unit apartment building or a 200 unit apartment building. It's not a lot more work than buying a 10 unit building. So,
Love it. The final question I'll leave you with, I don't want to take too much of your time, Christian. If you had to restart today to build yourself and your wealth up, what would you do?
I think, one of the things that I didn't do and I learned uh, as I went along was the proper science around real estate investing. It's not a black art. It really isn't. There's proper mathematical science behind it. And I figured it out because I'm good at math, okay?
Hmm.
And I understood business. So it made me get there reasonably fast. But if I had, a good coach that truly understood that, or even taken courses that truly understands that, and trust me, there's a lot of not so good courses out there, and there's a lot of
Hmm.
terrible coaches out there. So I'll make sure that people, you've got to do your diligence. You got to research these people and make sure that they are as good as they say. And if they're not actively investing in what you're looking at, then they're probably not the coach for you anyway, right? There's
Yep.
probably a reason they aren't. They might be making just their money on the coaching.
Yeah.
But if you get the right coach, right, it's going to accelerate your learning. Not that you couldn't do it yourself, but maybe it takes you 3 or 4 years to figure out all the science behind it. And if you have a good coach, maybe you figure it out in 6 months. Well,
Yep.
now you've got a 3 year advantage on where you are. And as you know, money compounds,
Yep.
right?
Yep.
So, if you take 3 years, you've got 3 years of that you didn't get to benefit from that compounding, which really makes a big difference over the long term. So, as I reflect on what I did, and I really at the time didn't think there was value in the coaching piece of it, and I
Hmm.
didn't do it. I honestly didn't do it. I didn't think there was value. And I look at it in hindsight and thought if I had the right coach, I would have been able to build my business even bigger than it is now. And I would have been able to get, maybe started the transition from the private sector to entrepreneurship a little faster. So. I think that's probably the key answer.
I love it, Christian. Thank you. I know you guys have some coaching, things like that. Is there anywhere we can get your content or any of the listeners?
Oh, yeah, sure. I do some, but I'll be honest, I didn't say all that because, I do coaching. Honestly, I don't. And
Yeah,
and I honestly do very little of it. So I take on 4 or 5 clients max at a time. And because my day job is investing, and
100%.
that's literally what I do. But I wanted to give back in some way. A friend of mine, Bruce Firestone, suggested that I get into this because he knew that I wanted to give back to the community.
Hmm.
So I set up a website called Aliferous Academy, which
Yep.
has a bunch of content. There's tons of free content in there. There's seminars that I've held that give a very clear understanding of how I do stuff. And for people who want to go a little bit further and they want to take some more formal courses in there, they're quite welcome to subscribe to the content there and go from there. But like I said, it's for me, it's not a profit center. Actually, it's actually a loss center for me because we continuously invest in it, and it really is part of giving back. So
Love
even
it.
if you're not interested in my stuff, do something with somebody else.
I love it. Thank you, Christian, for your time. That was great.
Yeah, absolutely. And I assume that all that stuff will be in the show notes anyway, so I'm sure people will be able to get the URLs, etc. So
Absolutely. Take care,
great.
Christian.
Thanks, Garrett.